So Capital Alliance just reported a massive 38.5% jump in profit. But when you dig into their financial report, there's a fascinating and, well, a really contradictory story hiding in there. We're going to break down what's actually going on.
And right up top, just so we're clear, this is fundamental analysis for educational purposes. It is not financial advice.
Okay, so a 38.5% year-over-year jump in profit, that is a staggering number for any company, right? On the surface, it really looks like Capital Alliance is just firing on all cylinders.
But you know, when you're analyzing a company, that headline number, it's never the whole story. It makes you ask the real questions. Is this growth real? And maybe more importantly, is it sustainable?
To figure that out, we've got to deconstruct that big profit figure. And when we do, it tells a tale of two very, very different income streams.
And here it is, the first major twist. The company's core business, its net interest income, the profit it's supposed to make from its main operations, that actually shrank by over 13%. The entire profit surge came from a massive 120% jump in trading gains. So you can think of it like this. The main engine was sputtering, but a temporary booster rocket made the whole thing look like it was flying to the moon.
And that's really the key takeaway here. This profit growth isn't coming from a stronger, healthier core business. It's coming from what looks like expert market timing. The problem with relying on trading gains, though, they are by nature super lumpy and unpredictable. You just can't count on them showing up quarter after quarter.
So, knowing their profit source is volatile, what's management's game plan? Well, the answer isn't on the income statement. It's hiding in plain sight on the balance sheet. They're actually pursuing a strategy that seems totally counterintuitive. They're shrinking to get stronger. Just take a look at these numbers. Total assets are down over 16%, and liabilities are down almost 20%. Now, in a world where it's all about grow, 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 this company deliberately got smaller. This wasn't an accident. It's a conscious decision to pull back. And this chart really shows you why. Their gearing ratio, which is basically a measure of how much debt they're using to finance everything, has been cut dramatically, from over 7 down to under 6. In simple terms, they're taking a lot less risk off the table.
The crucial point is that this isn't a sign of weakness at all. It's a calculated, strategic choice. Management is sending a clear signal that in today's choppy market, they value stability way more than just sheer size. And that, right there, is smart risk management.
Okay, so we know the profit source is volatile, but management is de-risking the company. So the final multi-billion rupee question is the profit even real? Is it backed by actual cash? We need to verify the quality of these earnings.
And the best tool for that job is the cash conversion ratio, or CCR. It's a simple idea. It measures how good a company is at turning its on-paper accounting profit into cold, hard cash. Anything over 1 is considered pretty solid.
So what's Capital Alliance's ratio? It's 1.49. And let me tell you, that is an exceptionally strong number. Let's just put that in perspective. For every single rupee of profit they reported on paper, they generated 1.49 rupees of actual cash that landed in their bank account. This confirms that even though the source is volatile, these are seriously high-quality earnings. This isn't just some accounting magic trick.
All right, let's pull all of this together. This look at Capital Alliance isn't just about one company. It really gives us 3 powerful lessons that you can apply to your own analysis of any business.
First, always dissect the profit. Look past that big, flashy headline number to see what's recurring and what's a one-off. Second, watch the balance sheet. Sometimes getting smaller is the smartest move a company can possibly make. And third, and this is crucial, always verify with cash. A strong cash conversion ratio is the ultimate lie detector for earnings quality.
Which brings us right back to our final question. After digging through all the evidence, what is Capital Alliance today? Is it this high-efficiency trading machine that spits out incredible amounts of cash? Or is it just a leveraged bet on market timing, with all the risks that come with that? The truth, as we've seen, isn't that simple. It's probably a little bit of both.